I thought it'd be a good idea to walk you through the answers to the second knowledge check in week one. Most of those were pretty straightforward, I think, once you saw the answers too. But there are a couple of them that I think people thought might have been a little tricky, and so I wanted to go through the answers to all of them. Question one, you sell stock, 30,000 shares at $12 a share, so you're going to receive $360,000 of cash, so cash goes up. And then we have to provide evidence that we now have more shareholders in the firm, so the shareholders section of the balance sheet has to increase. And we put this in an account called common stock to show that we have issued common stock to our shareholders in exchange for $360,000 of cash. In question two, manufacturing equipment is purchased for $95,000 in cash, so cash goes down, and another asset, equipment, goes up. This is what we call a capital transaction, or we're capitalizing the cost of the equipment. When you capitalize something, you record it as an asset, so the correct answer here is D. Now, number three was a little tricky because here we have special installation and testing is required in order to get the equipment ready for use. And a lot of people would probably initially think, oh, you should expense this. It's an expense. You're paying some workers or somebody to come by and set up the equipment. Now, you know, cash goes down $1,500, but what the accounting rules say is if these are costs that are necessary, are required to get the asset ready for use, you should capitalize those costs along with the purchase price of the equipment. So this $1,500 would be treated just like part of the purchase price. We'd capitalize it or add it to the equipment account on the balance sheet. So this would increase the recorded cost, or as we say, the book value of the equipment, and then it would mean there's a larger amount to depreciate going forward. So this would be the best way to handle this would be to capitalize this $1,500, add it to the cost of the equipment on the balance sheet. In question four, you obtain a patent. Patent's purchased for $25,000. Only you don't pay cash. You sign a note. You issue a note saying, I'll promise to pay you in a year or at the end of the year. So in this case, an asset still goes up, patent, $25,000. And instead of cash going down, because we're not paying cash right now, we now have a liability that we're going to have to pay off. So the liabilities go up. We call it note payable. So the correct answer there is A. Number five, you're buying raw materials inventory. So this is very similar to buying equipment or any other kind of asset. You're paying cash, so cash goes down $40,000, and another asset, raw materials inventory, goes up $40,000. So you're really just exchanging one asset for another. Now, if you discover some of those materials are defective and you want to return them, that's fine. So you send them back. There are different ways you can do that. Here we'll keep it simple. So we call up the supplier, say we're going to send them back. We can't use them at all. You know, sometimes they'll give you a price discount or something like that. Here we don't even want them. We want our money back. So we send them to the supplier. They send us our money back. So we're basically just reversing out the previous entry to the tune of $800. So we're going to add 800 to cash and subtract 800 to inventory to provide evidence of the return, and that's answer A. In 7, we open up a line of credit with the bank for $100,000. Now, opening up the line of credit doesn't require a journal entry. It's only when we start taking some of the cash on the line of credit. So when we borrow $40,000, that we make an entry for. So cash increases because we're borrowing $40,000, and we have a loan, a liability, a loan payable of $40,000. Now we're going to have to pay interest on it. I understand that, but we don't recognize any interest yet. You recognize interest expense as time passes. It's only while you use the money, while you have the money and you're doing something with it, as time passes, that you actually get charged interest expense. We often refer to that as the time value of money, or money has a time value to it. In other words, you incur the expense of using the money over time. So until time passes, we're not going to recognize it. So technically, we'd wait till January 22nd and then January 23rd to recognize some of the interest expense. As a practical matter, companies will just do that periodically, like once a month or probably once a month or every quarter, whenever they want to update their accounts. That's when they would recognize the interest expense. Now, question 8 is an interesting one because here we sign a lease for a retail location, and the lease agreement requires lease payments of $3,500 a month, where in January, the lease doesn't begin till February. So we haven't done anything. We haven't made any down payments or anything. We agree that on February 1st, we'll write a check and we'll take occupancy of the shop, of the store, of the building. So at this point, all we've done is sign an agreement, sign a lease agreement. We haven't given up any cash. We haven't received any cash. Nothing else has traded hands. So we call that an executory contract, meaning that neither side has performed their side of the contract. And in the accounting world, we make no entry for that transaction. So obviously you have legal documents and you'll know that you've entered into the agreement. We just don't make a journal entry into the accounts until something else has traded hands. All right, if we had gone ahead and made a $3,500 payment, then we would record that. We would reduce cash and show it as some sort of prepaid rent as an asset account. But until we do that, no entry is required. Now compare that to number 9, where we actually do pay something. All right, so we're doing the same sort of thing. We're buying a 2-year insurance policy in advance. It's January. The insurance policy isn't going to begin until February 1st, but we actually write a check. So the fact that something additional has traded hands, it's not just an exchange of promises to do something, but we've actually written a check and sent it along. We've got to record that. So cash goes down 10,000 and we record an increase in an asset account called prepaid insurance. So that's answer B. And then each month for the next 2 years, we would take out what, 1/24 of the prepaid insurance and show it as insurance expense on the income statement. These executory contracts are always, I think, a little unusual to people new to the discipline. And here's just another example of it. And probably, we really think about this a lot with our favorite sports teams or whatever. Our football team or basketball team signs a star player. They always, make a big deal about the contract. They get $20 million, $50 million, whatever it is. And just signing the contract, signing somebody to that, there's no journal entry in the books. It's only when we actually pay their salaries. So filling several key positions on the management team, hiring them for long-term contracts, agreeing to pay them fabulous amounts of money, none of that gets recorded. We wait until they work for us, and then we accrue salaries expense, and we write them a check. We show that decrease in cash. So number 10, the correct answer is A, no entry required just for hiring somebody and agreeing to pay them a certain salary.